What is a convertible? A convertible security can actually be explained very simply. Almost all convertibles are bonds, and a typical bond is issued in a denomination of $1,000. And if it's a convertible bond, it will be convertible into a fixed number of shares of the issuing company. This can be easily explained by way of an example. We have a $1,000 face value bond with a 5% interest rate that matures in 3 years. So you can see that in 3 years, you're going to make 15% on this bond. But this example is a convertible bond, typically convertible at issuance into perhaps $800 worth of common stock. So you're paying $1,000 for the right to buy $800 worth of shares. In our example, the stock is trading at $20, so the convertible is convertible into 40 shares. And when we look at what might happen, again, if nothing happens, we're going to make our 15% in 3 years. But if this stock goes up, if it goes up 100%, we get a total return of 60% from the bond because the conversion value isn't $800, it is now $1,600. We convert our bond into $1,600 worth of stock, and we've collected 15 percentage points in interest. So we've made a return of 75% while the holders of the common made 100. We've got 3/4 of the return that would have been earned from taking the relatively huge risk of owning a common stock, which could go down substantially. Whereas our bond pays the interest and matures at par if we merely avoid default. The key reason companies issue convertibles is to fund growth. That convertible issuers tend to have faster growth. We can demonstrate this statistically, that the sales growth of companies that have issued convertibles is higher than that of the S&P 500. The farthest back we've gone is a railroad convertible in 1837. And you can imagine this was the great technology of the day. I mean, applying steam to locomotion, tremendous breakthrough. And look, fast forward, and we look at companies that are in the convertible market. And if we start in the alphabet, we've had Amazon in the market. And we often have some financials too. Bank of America is in the market. And at the end of the alphabet, when we really hit pay dirt, in the T's, in that we have in alphabetical order Tesla, Teva, and Twitter. Cutting edge companies that either are technology companies or are big users of technology. The big attraction is capturing this asymmetry that comes naturally. Convertibles promise to capture most of the upside from underlying common stocks while providing a tremendous cushion on the downside. We have very good data going back to 1973, and we have some data even earlier. And it drives home the point that when you stand back from the chart, the total returns from convertible securities are essentially indistinguishable from common stocks. In strong bull markets, convertibles may lag a little bit, and in bear markets, they will significantly outperform. And when you come back after years and cycles and decades, it's essentially a match. The graph lines converge between convertibles and common stock indices. We all know that over time, common stocks have the highest return. And it's very noticeable, therefore, that convertibles, while they are fixed income instruments, significantly outperform other fixed income securities, including high yield bonds, which obviously have higher yields than convertibles, but they have much higher default rates than convertibles. Even bank loans default at a significantly higher rate than convertibles have historically defaulted. A key concern right now is the risk that interest rates rise. And this is a huge risk for any accounts owning Treasury securities, which tend to have the longest maturities and therefore the longest durations. Convertibles have short durations, reflecting short maturities of maybe 3 to 7 years. One of the features of convertibles that has improved in recent years structurally is maturities have gotten shorter, and the shorter the duration, the less sensitivity to rising interest rates, the less the price of the bond has to go down to match the new higher interest rate required by the market. Moreover, equities often go up during periods of rising interest rates. Interest rates typically are going up during strong economies that are periods of bull markets. And therefore, our convertibles are likely to become more equity sensitive at the time when being bond sensitive is dangerous and might create losses. The key advantage to active management of convertibles is that it's possible to outperform the indices with active management, that the convertible market is a niche market. 400 billion is large enough for global liquidity, but it isn't gigantic by global standards. Credit research properly done, and it's a specialty of ours at Advent Capital Management, it transcends accounting and reported earnings and sleight of hand, excluding all bad stuff. Credit research gets down to the reality of cash flow and balance sheets. And I can tell you that it may require genius to avoid common stocks that sometimes go down, but it only requires intelligence and sophistication to avoid defaults, to do proper credit research. And with proper credit research, we really do have the downside protection in our convertibles so that we have this a very favorable asymmetry. That is that we're winning by not losing with convertibles. Our risk of losing is radically reduced relative to outright ownership of common stocks, yet we're capturing most of the upside relative to common shares. The last thing I'll say about actively managed convertibles too is it's not just a matter of protecting on the downside and minimizing volatility, but we can tilt in favor of higher yielding convertibles, and we can manage the portfolio to get good income from our convertibles. In the media, convertibles are regarded as complex, and frankly, even the way I can explain a basic convertible bond isn't something that can be done in a 30-second soundbite. So the media tends to ignore convertibles, even though the market globally is over $400 billion. So there are plenty of convertibles for investment by major institutions as well as individuals. Convertibles are flexible. They can be used as income products, as bond-like products, and mixed in with a fixed income allocation, or they can be regarded as equity alternatives, which they really are. Indeed, it requires thought on the part of the advisors and the investors into how much they want to put into this attractive convertible market that is different from the normal allocations either to the low-risk bonds or the high-risk common stocks. The fact that convertibles become more equity sensitive when stocks are going up and more bond-like if stocks are going down. In essence, it's an automatic transmission that shifts in favor of stocks in a bull market and downshifts to bond-like performance in a bear market. Convertibles are an ideal investment for the few sophisticated investors who take advantage of it. The concept of favorable asymmetry, in essence of winning by not losing, may not seem exciting for a soundbite on the media, but it's certainly a fruitful way to build and preserve wealth over time.